Okay, so this video lecture is the continuation of our module number 8, accounting for factory overhead. So we are now in the fourth topic for our computation of factory overhead variance. So basically in variance analysis, the total fixed overhead variance is divided into two. We have spending variance and volume or efficiency variance. Okay, so for each of this classification, we will discuss the variance for variable factory overhead and fixed factory overhead respectively. So meaning to say, your variable factory overhead will have spending and volume or efficiency variance, as well as your fixed factory overhead will also have spending and volume or efficiency variance. So let us discuss first variable factory overhead variances. So for variable overhead rates, basically our basis used is either direct labor or machine hours. So for the variable factory overhead variance, this is the total variance for factory or variable factory overhead. So this is equal to total actual variable factory overhead cost minus total standard variable factory overhead cost. Meaning to say, this is just the difference between the actual variable factory overhead minus the standard factory overhead. Okay, so the total actual variable overhead cost and total standard cost are computed as follows. So when we say total actual variable factory overhead cost, this is equal to your actual hours used times the actual rate per hour. Actual hours times the actual rate. For the total standard variable factory overhead cost, on the other hand, so this is equal to standard hours for your actual production times the standard variable factory overhead rate per hour. So meaning to say, this is the the standard hours and the standard rate. Okay, so that's how you determine. And then after determining this actual and standard variable factory overhead cost, so we can now deduct this and get the total actual variable overhead variance. So again, please take note that the hour that is used here refers either to machine hours or direct labor hours, or depending upon the company or the entity. So most likely in a capital intensive industries, they tend to use machine hours. Other bases may also be used, especially when they are using the activity-based costing. So we go now to the variable factory overhead spending variance and efficiency variance. Again, efficiency is the other term for volume variance. Okay? Variable factory overhead may be split into spending and efficiency variance respectively. So how do we get the spending and efficiency variance for variable factory overhead? For spending variance, this is we will deduct the actual rate minus the standard rate and then multiply it with the actual hours. Again, we are talking about spending variance here, so it refers to the cost. So that's why our variable here that we use in the formula is the rate. So again, this is the difference between your actual rate and the standard rate. And then after that, we will multiply it with the actual hours or other bases to get the cost. Okay, spending, we are talking about thus as the cost here as well. Now, in terms of efficiency or volume variance, so the formula will be actual hours minus standard hours, and then we will multiply it with the standard rate. So in this case, when we say efficiency or volume, we are talking or relating to the number of hours spent. That's why our variable the variable that we use in our formula is the number of hours. So again, this is between the actual hours minus the standard hours, and then later on we will multiply it with the standard rate. Okay, so this is how we compute your spending and efficiency variances for variable factory overhead. Now, let us discuss each of this specifically. Okay, for variable factory overhead spending variance. Okay, so normally, for better control and faster recording of overhead cost, we use, or the entity uses, standard rate. So this may be used and applied based on either your machine hours or labor hours or some other applicable basis. So this is also known as our budgeted factory overhead rate, or the other term that we are using here is the application rate. So for further control, an application rate may be established separately for variable and fixed overhead costs respectively. So meaning we will have application rate for variable overhead cost and another for fixed overhead costs. Okay, for our spending variance, the formula is for variable factory overhead spending variance. So our formula, as also presented earlier, this is between the actual rate minus the budgeted rate, okay, or standard rate. The other term for standard is budgeted. Okay, and then we will multiply it with the actual allocation base. Okay, so actually in spending variance, this one is just the same with this one. Okay, so instead of using standard, we use the budgeted, because standard also is that refers to the budgeted. Okay, standard and budgeted are used interchangeably, okay, in this context. Okay, so actual allocation base, this is your actual hours. For example, direct labor hours or machine hours. Okay, just like in our first formula right here. This is just the same. Okay, but the term used is different. So again, it is used interchangeably. Okay, so it may also be expressed as actual rate times the actual allocation base minus the budgeted rate, okay, times the actual allocation base. So this is also the same with this one, but the term is different, and this one was actually multiplied directly to the actual allocation base, or the number of labor hours or machine hours, and then we will just get the difference. Okay, but it's just the same if you could analyze it. Okay, or actual variable factory overhead minus budgeted rate times the actual allocation. So since the actual cost is equal to the actual rate times the actual allocation base. So this is, you can use any of this formula, whatever or whichever the problem may present as the data presents, I mean, in the problem. So you can use either of this formula variables, I mean, in determining your variable factory overhead spending variance. Okay, so the budgeted rate is equal to the budgeted cost divided by the budgeted allocation base, and your actual rate, this is equal to the actual cost divided by the actual base. Okay, so again, whichever may the problem will present or will be given. So the most commonly used allocation again is either direct labor hours or machine hours. So generally, labor hour is adopted by labor-intensive industries and machine hour by the capital-intensive industries. Again, other bases may also be used. So we have here an example to understand better. So XYZ company, they have a variable factory overhead budget of 1,320,000. So they are producing 120,000 units of its product. One unit requires 2.75 labor hours to complete, So that is a total of 330,000 hours. So hence, the budgeted application rate for variable factory overhead is 4. That is 1,320,000 divided by 330 hours. So last month, XYZ produced 9,600 units and they employed 29,000 direct labor hours. So the actual factory overhead is 121,800. So in this case, we will compute the variable spending variance. So using the formula, actual rate minus the budgeted rate, okay, times the actual allocation base, or this is the actual hours, direct labor hours. So 4.20. Okay, so this is the actual rate. Okay, so actually this is 121,800 divided by 29,000 hours. Okay, so this is how we compute the actual rate. Okay, actual variable factory overhead divided by actual number of direct labor hours spent. So that's 4.2. Minus 4, this is the standard or budgeted rate. And then we will multiply it with the actual number of labor hours, okay, spent. So therefore, our variable factory overhead spending variance is equal to 5,800. This is unfavorable. So later on, we will discuss why this variance is considered unfavorable. Okay, so this is this second computation is using another formula, but again, we will arrive at the same answer. Okay, so how do we determine if the variance is favorable or unfavorable? If the actual rate is higher than the budgeted rate, meaning the company paid more than what it anticipated or budgeted, then the variance in this case will be considered unfavorable, because if you could notice, the actual rate is 4.20 and the budgeted is only 4. So meaning to say, actual rate is greater than the budgeted or standard. So that makes this variance unfavorable. Okay, so on the other hand, if the actual rate is lower than the budgeted rate, then your variance will be considered favorable. Okay, that's for variable factory overhead spending variance. Now we will move to the next variance under the variable overhead. So this is efficiency or volume variance. Okay, so in standard costing, factory overhead is applied based on certain allocation base. Okay, so the most common again is direct labor or machine hours. Or if they are using again activity-based costing, they can use another basis for allocation. So to apply or to understand better, we have here an example. So a company has a production budget of 20,000 units. Each unit, it requires 4 labor hours to complete. The company has factory overhead budget of 400,000. They are using labor hours as their basis. So the budgeted factory overhead application rate is 5 per labor hour. Meaning to say, this is 400,000 divided by 80,000 hours. 4 hours or 4 direct labor hours times 20,000 units. Okay, that is 80,000 hours all in all. So standards are used to facilitate better control and speed up the recording process as well. So to better manage the accounts, standards may be established separately, again for variable and fixed overhead respectively. So our formula for variable factory overhead efficiency or volume variance is as follows. So this is equal to the actual allocation base minus the standard base, and we will multiply it with the budgeted rate. Again, budgeted here is equal also to the standard rate or base. So it may also be expressed as actual allocation base times your budgeted rate minus the applied fixed factory overhead, or actual allocation times the budgeted rate minus the standard base times the budgeted rate. Okay, so we will just get the difference of this. This is just again the same as here and with the first one that we have shown you earlier. Okay, so the applied variable factory overhead is equal to standard base times the budgeted rate. Okay, so to understand better, let us take this example. So XYZ company has a variable factory overhead of 1,320,000. So this is the same with the first, I think, example. Okay, they produced 120,000 units of its products. So the 1 unit requires, in this case, we have a different variable amount. So 1 unit requires 2.75 labor hours to complete. So that's a total of, the same, sorry. So therefore, we have here the total number of hours or labor hours of 330,000. Hence, the application rate or the standard or the budgeted rate per labor hour is 4. Okay, so that's again 1,320,000 divided by 330 hours. So last month, they produced 96 units and employed 29,000 actual direct labor hours. So the actual factory overhead is 121,800. So to compute for our efficiency variance, we will take the formula as given. So this is equal to actual actual allocation base. Yeah. Actual allocation base minus the standard base times the budgeted rate. Okay. So the actual number of hours is 21. Okay, 26,400 is the standard. How do we get 26,400? This is by multiplying 9,600 units times 2.75 hours, okay, required labor for each unit. Okay, and then we will multiply it with the budgeted rate of 4. So therefore, our variable factory overhead efficiency variance is 10,400. So again, in this case, this is unfavorable. Okay, so again, later on, we will discuss why this variance is considered unfavorable. So you can also compute variable factory overhead efficiency variance using this formula. Okay, actual allocation base times the budgeted rate minus the standard base times the budgeted rate. Okay, so here actual allocation base is 29 actual hours times the budgeted rate of 4. Okay, and then your standard allocation base is 26,400. So again, earlier we have discussed how it was computed. So again, either of these two formula, we still get the same answer of 10,400 unfavorable variable factory overhead efficiency or volume variance. So how do we determine if this is favorable or unfavorable? So if the actual base is greater than the company, meaning to say the company used more of its hours than what they are expecting. Hence, the variance is considered to be unfavorable. On the other hand, if the actual base is less than the standard, then in this case, our variance will be considered favorable. So in this case, since actual hours of 29 is greater than the standard or budgeted of 26, so therefore, the variance here is considered unfavorable. Okay? So those are for our variable factory overhead variances. So we go now to our fixed factory overhead variance. So here, the computation of fixed factory overhead variance is similar actually to our variable factory overhead. However, fixed factory overhead amounts are almost always given in total amount. Thus, it may or may not require additional computation. So this is, in the case of fixed factory overhead rate or variance, I mean, it seems to be a little easier than or compared to the variable variance. So fixed factory overhead variance is equal to total actual factory overhead cost minus the standard fixed factory overhead cost. Okay, so the total actual fixed overhead cost is always given. Hence, there is no additional computation, unlike with the variable overhead. The total standard fixed overhead cost or applied factory overhead can be computed as follows. This is equal to standard hours for actual production times the standard factory overhead rate per hour. So if you could notice, we have the same formula under the variable. We just used here the fixed, and the variable is also, of course, variable rate. Okay. So again, fixed factory overhead variance also has spending and volume or efficiency variance. So fixed factory overhead variance may be split as follows. So how to compute fixed factory overhead spending variance? This is equal to your actual fixed factory overhead minus budgeted fixed factory overhead. Whereas our fixed factory overhead volume variance is equal to budgeted fixed factory overhead minus the standard fixed factory overhead. So the budgeted fixed factory overhead is also given in total amount for a given level of production. So the total standard fixed factory overhead is computed as shown earlier, and this is also known as applied fixed factory overhead. Okay, so to understand better, let us discuss each of these variances. So first, we will discuss the fixed factory overhead spending variance. Okay, so we will take this example. XYZ company has a fixed factory overhead budget of 220,000 for a budgeted production, or this is considered to be normal capacity of 10,000 units. So one unit needs 2.75 labor hours to complete, which requires 27,500 hours. Okay. XYZ produced 9,600 units and it employed 29,000 direct labor hours. The actual fixed factory overhead is 221,500. So we will compute the spending variance. Okay, so again, spending variance is equal to actual fixed factory overhead minus the budgeted. So we will just get here from the given. So your actual is 221,500. Our budgeted is 220. So in this case, our spending variance is 1,500 unfavorable. So the actual fixed factory overhead is just compared with the budgeted fixed factory overhead only. So how do we determine if the variance is favorable or unfavorable? Again, if the actual fixed factory is greater than budgeted, meaning to say the variance is unfavorable because the company paid more than what it expected. So that's why it's considered to be unfavorable. So in our example, instead of just spending 220, the actual fixed factory overhead spent was 221,500. So that's why it's considered to be unfavorable. So on the other hand, if the actual fixed factory overhead is lower, so in this case, your variance will be favorable. That's for spending variance. And for fixed factory overhead volume or efficiency variance, okay, so in this case, in the standard costing, an anticipated amount is used to enable better control over cost and faster recording processes. So therefore, a predetermined rate known as budgeted rate is applied to our standard base to arrive at our standard or applied factory overhead. So the most common again basis for used, in this case, is either labor or machine hours. So let us take this example, okay, to understand better. A company estimates a factory overhead of 12 per labor hour. One unit requires 2 labor hours to complete. If the company produces 10 units, the estimated standard factory overhead would be 240,000, or that is equal to 20,000 hours times 12. So to better manage the factory overhead cost, standards may be established separately, again, as mentioned also earlier, for variable and fixed overhead rate. So for our formula, for volume or efficiency variance, this is equal to budgeted fixed overhead minus the standard fixed factory overhead. So again, standard is, or applied fixed factory is computed by multiplying the standard base for the actual output by the budgeted application rate. So let us take this example. XYZ company has a fixed factory overhead budget of 220 for production. Normal capacity of 10,000 units. So in this case, one unit needs 2.75 labor hours to complete, or it requires 27,500 hours. So they produce 9,600 units and they use 29,000 direct labor hours. Our actual factory overhead is 228,500. Using the direct labor hours base, we will compute the fixed overhead volume or efficiency variance. First, we will determine the budgeted application rate because this is needed to determine later on our variance. So, how to get budgeted application rate? This is equal to 220,000, which is the fixed factory overhead budget, divided by the 27,500 hours, which is also the budgeted number of hours required. So therefore, your budgeted application rate is 8 per labor hour. For our standard fixed factory overhead, so we will also need to determine this one. Okay, so this is equal to standard hours for actual output times the budgeted rate. So therefore, based on the problem, 9,600 units is our standard hours for actual output times the budgeted rate of 2.75 hours. And then we will multiply it with the budgeted rate. So times 8 right here. Okay, so that's why our standard fixed factory overhead cost is 211,200. So to compute for our volume or efficiency variance, this is equal to budgeted fixed factory overhead minus the standard fixed factory overhead. So budgeted factory overhead is 220. This is given in the problem. Okay, and then for our standard factory overhead, we just compute it earlier right here. Okay, so that's 211,200. So therefore, our fixed factory overhead volume variance is equal to 8,800 unfavorable. So why this is unfavorable? Again, if the resulting amount is positive, meaning the budgeted fixed factory is greater than the standard, it means that the company has underutilized the capacity. So therefore, in this case, our variance is considered to be unfavorable. Because in this case, our standard should be 211,200, but the budget is only 220. So it's underutilized. That's why the variance here is considered to be unfavorable. If the standard fixed factory overhead, okay, is higher, okay, the company was able to exceed, then your variance is favorable. Sorry, in this case, I mean budgeted is greater, 220. The standard is 211. This is underutilized because the budget is at 220, sorry, 220. And the standard is only 211. That's why it's unfavorable. Okay. And again, if the result is the opposite, meaning your standard in this case is higher than the budgeted, then the result will be favorable because according to our rule, in this case, the company was able to exceed its capacity. That's why the variance is considered to be favorable. Okay. So that's for our volume variance or variances for our factory overhead for variable and fixed overhead respectively.